Okay, let's move on. We have a corporate conversation now lined up. The stock in focus is CEAT. Now, it's been a mixed bag for the company in the first quarter. Revenue saw a healthy growth, but margins have fallen for the third straight quarter, impacted by higher input costs and rubber prices, which have been rising higher. To talk about the performance and the road ahead, we have Mr. Arnab Banerjee, MD and CEO of CEAT, with us. So let's start with the performance. Revenue up almost 9%, but your margins are under pressure. Is it just raw material? Is it something else? Do you see this pressure coming off?
So when should I?
I think you're on mute.
Sorry about that. So good morning. The revenues have indeed taken off well, with double-digit growth in replacement and international market. These are the two profitable segments which have moved up now to 75% saliency overall. Margins are under pressure primarily because of input costs. I think we have doubled down on efficiencies because of our lighthouse implementation in Halol as well as Chennai. Manufacturing cost has come off well. It's primarily natural rubber, which is at a 13-year high within a short span of time. And as I had been mentioning earlier, if the inflation happens gradually, we can manage the margin easily. If it happens in a short span of time, like it has happened this time on the natural rubber front, it has an impact on margin in a quarter kind of time frame, because price increases which are happening with a lag.
All right. Hi, sir. Good morning. Nigel on this side, and good to see you in. Give us a number, the average price of rubber for the past quarter. I think it was hovering around 150 per kg. Then it went to around 190 per kg. So what's the average for quarter one? And at current reckoning, what is it?
So it's close to about 185 to 190 in quarter one. And right now it's hovering at around 209 as we speak. So we expect this to stabilize and taper down as the tapping comes out. And there's a huge amount of rainfall also in the southern parts of the country. Container availability for imported rubber is also an issue right now, so which is leading to speculative activities. We expect this to stabilize by mid of quarter two. And hence, we don't see it as a very long-term trend, and this spike should stabilize and start coming down.
Okay, what does it mean in terms of margins then? Because margins have come down from close to 15% to around 12%. But to be fair, Mr. Banerjee, you had indicated in your last interaction with us that the first half of the year will be weak and then you expect it to recover. So do you see it recovering in the second half of the year? If yes, should we get closer to around that 14% odd mark?
Yeah, I've been mentioning that we would like to keep our margins within a narrow band, and we've just fallen a little bit behind of the lower end of the band at 12%. Quarter two, the raw materials basket is expected to rise by another 5 to 6% over quarter one. So quarter two, the price increase impact which happened in quarter one also will be felt in quarter two. We have to manage quarter two prudently. And thereafter, we expect the pressure to ease out in half two of this year. And we are also seeing a very robust demand in margin accretive areas, which is international sales, two-wheeler sales. Rural demand is coming back, and also passenger car tire sales, where we have started investing heavily.
Got that. Mr. Banerjee, hi, good morning. Prashant here. So just to stick with pricing for one bit longer, some have made the case that there is there is structural sort of pricing, a pricing strength available in the industry, and you're kind of well capitalized to take advantage of that with your brand, etc. Is that really the case? Right now, of course, prices are going up because you need to, and that's happening with a lag, as you said, and things will stabilize in a quarter or two. But is that are underlying conditions favorable to support slightly premium pricing over a period of time?
Absolutely. The key enabler is the demand situation. I think replacement demand is pretty good. Commercial segment, passenger segment, as well as two-wheeler segment. As I mentioned, the rural demand is coming back. Rural growth is higher than urban growth. So if the demand situation is supportive, we will be able to take pricing up in passenger as well as in truck bus radial, where our products are getting accepted because of superiority in performance. Which is being seen by the end customers through repeated trials and efforts over the last few quarters. So we are pretty confident about being able to take price up, but it will happen with some lag.
Okay, very quickly, Mr. Banerjee, you were targeting high single-digit growth, volume growth for the year. At current reckoning, do you believe that you can get to that? And coupled with the price increases, do you think the revenue growth for the year should be in the vicinity of around the mid-teens?
Mid-teens exactly, I cannot say, but definitely double digit. We are pretty bullish on the top line growth and in the right areas, which is international. Our order book is absolutely strong. And there's some disruption, as I mentioned, because of container availability and freight rates, etc. But on a long-term period of 2 to 3 quarters or 4 quarters, we are pretty much confident on that front. Our two-wheeler sales is robust. Our four-wheeler sales is going to improve in future. And we have done remarkably well on the commercial vehicles tire sales also. OEM was a little bit subdued for us in quarter 1. Which is expected to pick up with the new models which are getting rolled out on CEAT tire, and we are nominated on that. So we are quite confident of double-digit growth.
All right, double-digit growth on the top line with the margins headed, towards that 14% odd is what you're guiding for. Thanks a lot, Mr. Banerjee. First quarter a little bit weakish, but hopeful of a recovery in the second half of the year.